I kind of started by saying, let's go back to banking. But at the same time, you also have to straddle and understand and navigate some of these geopolitical tensions between DC, between China, between DC and Europe. So what's the most complicated thing for you right now?
Probably the pace of change. As you said, every week there's something else that you have to factor into how we run the business. Look, we've been around for 160 years. We're pretty good at this. We've managed through several world wars. We managed through lots of geopolitical tensions. So, and we're a very strong institution, very large balance sheet, lots of liquidity, fortress balance sheet as well. But I do think it's the pace of change and how we help our clients navigate through that pace of change.
Will tariffs be different in 2026 to 2025? It seems that, we were very worried about what tariffs would do. I'm sure a lot of clients were calling you up saying, how do I navigate this? They're changing the supply chains. Then we forgot about it, saying, okay, we're over the worst. And now they're back at the forefront.
Yeah, no, you're right. In fact, I was amazed at how resilient the supply chains were. I mean, all the Liberation Day chaos that came afterwards. And I was, in fact, traveling then, and there was nothing but
calls.
Yeah, exactly right. And so now people, to your point, got used to it. I think the supply chains have been reordered a bit. I think, in fact, trade last year was up, which most people don't realize. It's $37 billion. It was up by $2.5 billion, or trillion, sorry. And you could see that what was happening, people just got used to it and accepted the fact there was going to be, on average, 15 to 70% tariffs. Now this is yet more surprise, more chaos, more unpredictability, I think, put into the system. This one, however, is not just a Liberation Day. This is obviously politically driven, and that's a little bit different.
What's the risk to HSBC and the wider banking sector?
Look, I think, again, the risk are really more for our clients. It's not a big risk for us. I think we'll be able to get through it. It's really trying to help clients who, in particular European clients, who sell into the United States, because this is all levied against, of course, European countries. And that's going to be challenging for them. They've accepted the 15% tariff, although, of course, those negotiations seem to be stalled. And then on top of this, whether it's 10 or up to 25, it's quite a lot. And so for them, most of whom have very sizable operations in the U.S., that tends to be the largest operations outside of the home market, sometimes even more than the home market. Think of the Swiss companies here. So I think it's going to be quite a challenge. And so we'll try to help them figure that out. It stresses cash flow. It stresses just revenue, in a time where, debt is rising in most corporations around the world. That could be problematic as well.
Michael, HSBC shares now trading around all-time highs.
Yeah, we like that.
How higher can they go?
I hope a lot higher. So, no, we're very pleased with the progression in the share price, and I think it reflects, as you mentioned earlier, the transformation that we went through. It's really paying the dividends, we thought. As George has said many times, we're going to hit the numbers we've told the street, and they could see that not only is this an efficiency play, which it was, it really is making HSBC it's a better organization, more agile, more customer-centric, less complex, which was always really, I think, the challenge for HSBC. And so we hope, I don't know where it's going to go. I hope investors see the value and the benefits, and it keeps going up. I think there's more buy than sells, which we love to see. So we hope it goes much higher.
I mean, you must have celebrated in December. I think you became a £200 billion bank.
We
right?
did. And
is $300 billion next?
I'm hoping so, yeah. And I think that's the trajectory. I mean, if you could see, to your point, from 200 to where we are today, 266, 270, to get to 300 is so certainly within reach, and that's where we want to be. We are one of the most important global banks in the world. We operate 55 countries, $3.3 trillion worth of balance sheet. That really, in our opinion, given where we think we can generate the profit, really deserves a much higher rating.
Is that it for restructuring?
I think we've gone through much of it. There's some trailing issues we're going through, which is always the case, but the bulk of it, yes. And the CIB, which I manage, is the largest part of that restructuring. And I could say we've gone through a very, very quick organizational change for such a big organization. That was the focus. Very intentionally did we want to go through a quick series of changes because we did not want to drag it on. Bad for clients, bad for employees, bad for everyone. And so the bulk of that is certainly done.
was going to ask actually about morale. So is it better just to get done quickly so that then people feel better? And so how's morale right now?
Look, I think morale has rebounded, and I think George has said, that toughest thing is to say goodbye to some very long, time colleagues and friends. That's been done. That was done early in the process. So we can really safely say we're looking really to the future, and I think that is what builds better morale when people know the transformation's over. But I think they're very excited, actually. They're excited about the pace we've used to change the organization. They're excited about the direction, excited about the stock price. They're excited about some of the things we're doing, which really, I think, paint a very positive picture. But they don't like the uncertainty. And so that's why we went so quickly, is to get rid of that uncertainty.
Michael, talk to me a little bit. I mean, here we have a lot of U.S. tech firms, and we talk a lot about AI. Talk to me about quantum tech and how you're expecting that to transform HSBC.
Yeah, we have a joint venture with, or a joint initiative with IBM, really to develop quantum computing, which we did sort of as initially to look at how we could match buyers and sellers in the bond market, and to give better accuracy and predictability on where we should actually try to sell our bonds. It actually did improve it. Now, so it's just a first initiative, something that we think has value, because I do think quantum computing will become more and more a part of how banks trade. It's a big part of how we manage our cybersecurity, by the way. So it's already embedded in our cybersecurity, but now we're taking to more of a revenue generation type of activity. It's a first, so I don't want to get too excited about it. We have more to do, but we were very excited with the results, and IBM's been a great partner in that as well.
Michael, I mean, if this is successful, like how large could it be? Like how much of a transformation could this actually be for HSBC and the sector?
Yeah, I mean, if you think, without doubt, most trading will be on a tokenized basis, it will be on an AI basis. You're just adding a layer of quantum computing to make it that much more efficient. So trading of all asset classes, I mean, none will be immune. It's going to go through a fundamental change, and I think probably after AI and after tokenization, you'll see quantum come.
What are you expecting from AI?
AI will be quite significant. So I think you'll see, we do a lot of algorithmic trading already. I think, you'll have agents to agents start doing trading in the not too distant future. I think you'll look at different asset classes. Again, none are immune from that. And I do think it will speed up trading. I think it will make it more accurate. I think it will quickly become the way that most firms trade. And so we're in the process, like I'm sure many institutions, really embedding that into our trading.
Yeah, are staff anxious about it? Because it feels like when you speak to a lot of employees, they're worried that their job will disappear.
Yeah.
And so I don't know how you manage that.
I think it's a bit of both. Yeah, and we need to show that it's not just about staff reductions or staff efficiencies. It's really about us being more efficient in general, serving clients better. I think it's about us really using the capacities that we create through AI to allow staff to do other things. And banks are built on process and procedures. I mean, they're the perfect, user of AI going forward. And I really hope we can just free up all that time. And I don't think it'll lead to massive layoffs. I don't think it'll lead to massive change in how we do things, other than us to make it more efficient. For instance, our bankers today spend too much time on administrative details. If we can free up that time, I could put them more to work going to see clients, really bringing value to those clients.
And Michael, for the next couple of years, I mean, do you see these are huge investments, right?
Yeah.
So you have to upgrade systems, change systems. Does that mean that you'll hire a little bit less, that there's less young staff coming in, until the cost adjusts?
I think that's a great question. And that's one that I personally am very focused on. We are an apprenticeship culture. So you have to bring in younger people to give them the tools, the experience to do well. So I think there's going to be a lot of balance in between then. Yes, you could take one road to say we're going to just maximize efficiencies, not hire anyone, save a bunch of money, and plow it back in AI. Certainly there will be some of that, but at the same time, we really need to focus on making sure we bring in the young people to build for the future. And so there's going to be a lot of balance between the two.